Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Hello, James. Welcome to another episode of Enlightened Wealth Strategies.
Hello, Jim. How are you this morning?
We're doing good. I made it up here.
Lots of traveling.
Yes, indeed.
Well, very good. So we have a good guest today, a great guest, in fact. We are going to talk about what everyone likes to know about is the equity markets, the stock markets.
Ooh, that should be an exciting topic, considering how the markets are at the moment.
Well, they're behaving on an upward trend, more or less, I would say, right?
Yes, they are.
So we'll discuss, I think the things that we can talk about is what, with this guest, who we'll introduce in a moment, what the markets have done for the past year.
Okay.
We'll look at some strategies that we might be able to implement before the end of the year and into the new year. And then what to anticipate and expect
in the upcoming months.
In the new year, in 2026.
Yep. I think that'll be awesome.
Okay.
I like the topic.
Yes.
You know what we should do, though? We should ask the listeners what topics they would like us to talk about.
Go ahead, ask them.
Listeners, if you're listening, please subscribe and let us know what you're thinking, whether or not what topics you would like us to cover in the future.
Yes, be sure to like and subscribe.
Of course.
To Enlightened Wealth Strategies. Okay, so
that's awkward for us, isn't it?
No, not at all. Maybe for you. Because you sat in the car for a long time. All right. So let's introduce our guest.
Please.
Jack Lauroesch of Sumner Equities. I use him extensively for quite a few of my clients. He is, a part of our firm at Bell Point Wealth Management. And I'm not going to take away. I'm going to allow Jack to introduce himself, what he does, how long he has done it, and then we could begin the interview and giving him some pointed questions. I have some pointed questions for you, Jack.
Hello, Jack. How are you today?
I'm doing very well, thank you.
Where are you, Jack?
We're in sunny Delray Beach, Florida. So for anyone up north, it's very nice here.
Yes, well, Jack, we're slightly envious because Jim and I, as you know, are in lovely northern New Jersey. Just after a few days ago, we had a nice little snowstorm.
Which is early for this time of the year, isn't it? We normally don't get snow until January or February. Yeah. So,
but it's okay. It's winter.
Yes, it is.
Well, not officially. But.
Well, I was looking forward to maybe a white Christmas, but we'll see now.
And Bing and Danny Kaye will sing it for you.
There you go. Jack, we're sorry. We're getting sidetracked today. We're a little punchy. With that being said, though, why don't you share with our audience what you do and who you're about, what you're all about?
Okay. I guess you would mention something about how long have I been in the business. I won't go into the exact number, but it's, I know it's 40 plus years. So I've been doing this for a while. But our firm really specializes in managing what I would describe as personalized portfolios, both for individuals, trusts, and foundations are our clients. We're not, we don't run mutual funds or ETFs. And again, our emphasis is really trying to work with clients in terms of developing portfolios that specifically address their goals and needs. We do it with a combination of, we use equities. We do also have a fixed income component, and for some of our clients, we also use options in particular for generating income, additional income for folks. So that in a nutshell is typically what we're doing.
Yes, and I know that from firsthand experience that you and I, Jack, we've effectively doing a customized version, and that's what you're describing, correct?
Correct. Very
Yeah,
much so.
yeah, and from my perspective, as you know, when I work with my clients, I think you appreciate the fact that I do extensive and comprehensive financial planning, so that when I introduce a new client to you, that you are aware of what we're trying to do for them, what we're trying to achieve for them at this stage and age of their life, and then beyond, if they're, you know, at retirement or thinking of retirement or in retirement. They all have, you know, there's all different goals that we're trying to achieve for them. And I think when they get to that stage, you know, it could be that they're trying to accumulate more capital, they're trying to preserve capital, they're trying to generate income. And so, correct me if I'm wrong, we are trying to do each one of those things, or maybe all three of them. Is that correct?
Yeah, I'd say we're really trying to do all three, but the emphasis is a little different on each one, depending, you know, for some of our younger clients, generating wealth is more important. For some other clients, preservation of wealth is really critical. And then the income component, depending, are they in retirement? Are they approaching retirement? So yeah, those are really the three facets. I think most importantly is, you know, first and foremost, preserve and protect, and then, you know, grow and meet income needs as appropriate.
Exactly. Also, with regard to the option strategies, you and I have done that as well for a number of clients, both young and old alike.
Right.
So maybe, you know, before we go down that path, perhaps you could describe a little bit about how you construct a portfolio. Once I've given you some of the details and we've spoken to the client, how do you put that together to help achieve? Just say to somebody who's nearing retirement, so they're still a little bit in the wealth accumulation phase. What goes into the construction and design of their particular portfolio, if I've given you all the facts that you need?
Right. Well, a lot of it is going to be a function of, you know, where we are in the economic cycle, what, you know, what portions or what segments of the market look more attractive, what's the direction of interest rates. Yeah, I mean, there's so many factors that go into what we try to do, because what we're doing in particular is we're selecting individual securities. We're not, you know, we typically are not using mutual funds or ETFs. We're buying companies that we feel are going to meet the parameters of what our clients are looking for. And, you know, this year has been sort of an interesting example. You know, for much of the year, it was all about the Magnificent Seven. You know, everyone's talking about AI build out, data centers, you know, technology. And so, you know, obviously we want to have some exposure there, but at the same time, you know, valuations sometimes get ahead of themselves. I mean, you know, today actually is a very interesting day, because now people have decided that maybe there's been too much of an emphasis on monies flowing towards the AI build out center. So we're seeing a lot of the high tech stocks sell off, and the industrials and the financials, other segments of the market are doing better. You know, but again, as an example, up until the fourth quarter, healthcare was a major lagger. Now it's really come into focus. So, you know, really, when we're looking, one of the things we do emphasize is diversification, and we're trying to buy what I would describe as quality companies at good prices. So we tend not to want to chase, you know, today's winners. We would rather look for opportunities that are maybe a little bit off the beaten track. You know, some of the examples, you know, especially like this time of year, we're going to see a lot of tax loss selling. And sometimes companies that are actually doing quite well or beginning to turn around are still tax loss candidates, and they may get down to valuations that become very attractive, especially for picking them up at the end of this year or early next.
Before you go into the next point, could we emphasize a little bit about tax losses, taking those? That's really, you're describing tax loss harvesting, which is the common expression that we use. So maybe we can give a little bit more detail about that to our listeners.
Yeah, I mean, especially, we've now had 3 years in a row of very strong markets, 20% plus 2 years ago. We're up probably about 17% year to date. So a lot of people have realized very large capital gains. And, while it's okay to pay the tax, we would like to minimize that. So we're going to go through the portfolios and look and see, are there any companies that we own that have underperformed, that we have capital losses in, that we're not as excited about prospects going forward. We always look at companies, not what their history was, but where are they today? And, if we have a company that has not been a good performer and we think their prospects have diminished, they're a perfect tax loss candidate. The other thing sometimes we do is a little earlier in the year, we might take a tax loss with the idea that we may repurchase that company early next year, but we have to make sure we don't violate the wash rule. So
that's a 30-day rule, correct?
Exactly.
Yes. Yeah. Okay.
Yeah. So you might want to sell something 1st of December because you have a loss in it, but you still like the company, but then you can pick it up 1st of next year, once you've waited the 30 days and repurchase that company, but you've taken advantage of realizing the loss for this year. And, one of the difficulties we're having right now is frankly finding very many losses in our portfolio. And we have realized, a moderate number of gains, but again, that's one of the advantages of buying individual securities rather than a fund, is you have a little bit more control as to the mix and what you have to choose from.
Yes.
How do you get in, Jack, and I'm assuming it's based on the client's needs and stuff, but when you start researching your stocks, how do you determine which stock would be good for a candidate?
Well, I mean, we want to diversify, for certain clients, if income is an important component, then we might look at more dividend-oriented stocks. The other, really, I guess the first thing is, are we investing for a taxable account or are we investing for a retirement account? Our emphasis is on generating total return. The total return can come from income. It can come from an appreciation. If we're inside an IRA account, then, we can, for example, we can look at taxable bonds. We can look at option income. We can look at, dividends more so. Whereas let's say a taxable account, the most favorable tax treatment is going to come in the form of long-term capital gains. So we may have more of a growth orientation in a taxable account, whereas in a retirement account, we might look to have a little more in the way of what I would call total return stocks, where, an example, a company that we've been purchasing recently is Weyerhaeuser. They're a large timber and landowner. They pay a nice 3+% dividend. Plus, we feel as if the building industry has been out of favor for quite some time. So timber hasn't been utilized as much. They also carry a lot of land on their books, and they carry it at valuations that are much lower than what builders are paying for land. So that's an example of a total return type of stock. Whereas, everyone knows NVIDIA has been a dramatic grower, and, that's going to make more sense in a taxable account.
Yeah. So location is very important. is what you're saying, whether the location being, whether it's a retirement account or a personal taxable account.
Yeah, we might own that name in both places,
Mhm.
but especially, we do have clients where we're managing both taxable as well as tax exempt accounts. And in that case, we're going to probably weight more of our, dividend or income oriented positions inside the IRA or retirement account, and more of our, growth and capital gain opportunities in the taxable account.
Yeah, and that makes sense because any of the income-oriented positions like dividend-paying stocks or bonds makes more sense to be in a retirement account because you're putting it in that umbrella where it's not going to be taxed on their tax return, whereas the taxable account. It makes more sense to have capital appreciation stocks, and when you do sell it, you're taking advantage of the, as you mentioned before, the preferential capital gains tax treatment, which is much less than ordinary income tax rates. So that absolutely makes more sense. You would agree, right, Jim?
Absolutely.
Yeah. Okay.
Location.
And location. Okay, so do you have a question, Jim?
No, go ahead.
All right, maybe we could shift gears a little bit. So you mentioned before that the big drivers of the market this year have been the tech industry, the Magnificent Seven, and I'm sure we're all aware of the fact that a lot of investment has come from these companies into AI. And AI, people think only of the technology itself, but there's a lot that goes on behind the scenes. The infrastructure is really what I'm making reference to. So a lot of investment has gone on into, and I think you mentioned it before too, Jack, is data centers, the employment of individuals, of technicians and professionals, even electricians, and et cetera, et cetera. So to build this out. But these companies were rich with cash. They had a huge cash positions on their balance sheets. That's not as great as it had been a couple of years ago. So going forward, I guess the question I have for you is, moving forward, are these companies, since they've used up a lot of their existing cash, so moving forward, what will they be doing? Because I have read and I have seen where they're starting to issue bonds, and they're looking for ways to continue this financing. And I guess the second part of my question is, do you see parallels to what's going on today, what happened 25 years ago or so,
Tech bubble.
and the dot-com bubble?
I do think this era is quite a bit different than the dot-com. There are some companies, I mean, if we're going to get into names, Oracle has probably been the biggest question mark. Their ambitions have been such that their need for financing have been, well spelled out and are pretty dramatic. And the question is, are the cash flows going to follow? Whereas, some of the other companies, while their spending is high, they're still able to generate it, out of their current cash flows and balance sheet. So when we're looking at these companies, that's really an emphasis. One of the things we feel strongly about is, in the last couple of years, the Magnificent Seven have sort of moved as a group. We think there's going to be more dispersion going forward. We think, there may be 3 or 4 companies that do very well, a couple that, just sort of muddle along, and there could very well be a problem within that group. So, it's sort of monitoring where the money's going and what the opportunity is. I think one of the big questions is, with all this expenditure on AI, are the companies that are making the expenditures going to reap the rewards? will it really enhance their business? Is there, as much bang for the buck as the money being spent? So that's something, we really focus on. And, one of the reasons, every quarter we're listening to the earnings calls and trying to listen and hear what the CEO and CFO are saying, both about their prospects as well as, what their expenditures are like. So that is a big issue. But it also is an area, as you say, there's a lot of opportunities, the utility industry, in terms of providing energy has been a great beneficiary. There's a lot of companies that have been major beneficiaries. But then the question is, are the valuations appropriate? Because a lot of these companies really have run up in anticipation of all the business. A prime example is GE Vernova that's selling off dramatically today. It's down probably 5 or 6%, but they have a backlog of orders that are going to go on for maybe the next 5 years anyways. But how do you discount those orders and the cash flow back to a present value? What's an appropriate discount rate? So there's lots of questions in terms of valuation and, money being spent, and, is there double ordering? There are a lot of factors to be considered in looking at a lot of these companies.
Very true. Jack, also, I don't want to assume that our audience knows who the Magnificent Seven is. Perhaps you could name those names for us, those particular companies.
Well, we've got, I guess, Google or Alphabet. You've got Microsoft. You've got Meta. You've got, I guess, Meta, which being Facebook. You've got Tesla. Who are they, Jim? I'm terrible on the names.
NVIDIA.
Yeah.
That's six.
That's six. I don't know who the seventh is.
Is Oracle a part of that group?
No, Oracle is.
I didn't think so.
But there are other companies, again, like Lam Research isn't one of them, but it's
Amazon.
Amazon.
Yeah, Amazon would be the seventh. Thank you. But Amazon being a perfect example, the big emphasis is all about their data centers from a, Magnificent Seven standpoint, but they and Walmart seem to be, going head to head in the retail world. So they're, sort of multifaceted. Again, you look at Alphabet and their Waymo, is going probably head to head with Tesla. So there's a fair amount of overlap. But
Apple also fits into that.
Yeah, Apple's in there.
Yeah, so yes. Okay. Maybe we could shift gears a little bit. So we've discussed a little bit about what's gone on this year. We've also talked about some year-end planning that people can do. And what can people do for the new year in 2026? As far as investment planning is concerned, what do you do? What are the steps that you take on a when I say routine basis? As you mentioned earlier, you have been doing this for many, many years. I would assume that you have some regular steps that you take in the new year. Do you reallocate at the end of the year? Do you reallocate portfolios? Obviously, you're kind of doing a little bit of reallocation at the end of the year in anticipation of taking losses to offset those gains for individuals' accounts, obviously, particularly their taxable accounts. But I imagine you're doing some reallocation steps into the new year as well in anticipation of what you expect the markets to do. And one other thing that you commented too, which is very important, and we haven't really mentioned it, is you pointed out about interest rates, and the Federal Reserve has again cut rates, even though it was only by 25 basis points. But that's also an important component, I would assume, in your decision-making process going forward, correct?
All right. Yes, very much so. I mean, from a allocation standpoint, really for us, it's less about the calendar and more about what we see as the prospects for the markets, both the fixed income as well as the equity markets as we go forward. Right now, we're in a very interesting period. It's the end of the year for a lot of like mutual fund managers. If they've been underperforming, they're trying to catch up. At the same time, people are suggesting, and I think it's fair to say that market valuations are relatively high. So that's an important consideration. And where are interest rates going? Are we going to see the Fed continue to lower interest rates? What's going to happen in terms of inflation? There's sort of, if inflation stays up, will rates come down? Right now, I think the positive factors are, the big beautiful bill has provided a lot of, tax incentives, reduced regulation. In some cases, there's, sort of further government support of certain industries. So those are all on the positive side, as well as if interest rates are coming down, that should also be beneficial to the market. But on the other side of the coin, we have the potential for interest rates not to go down, which would be a disappointment. We do have high valuations, and then there are always world events. A couple of days ago, everyone had determined that oil prices are going to continue to come down, but if we get into a tussle with Venezuela and we'd stop receiving Venezuelan oil, what's that going to do with prices? So I think you always have to be on the lookout for either what's currently happening or what's likely to happen. And we'll probably adjust our portfolio weightings, as appropriate. A couple of years ago, when interest rates were very low, we didn't want to buy long-term bonds. We kept short in our portfolio. So for someone who needed fixed income exposure, our duration was very short. We've been able to go out a little bit farther. Rates are coming down. We'll probably extend duration a little more. So there's always, we're always making slight adjustments. We seldom make wholesale allocation changes, but we will reduce or increase equity exposure as we see, valuations and opportunities. And there'll also be rotation. For example, as with the run up in tech this year, we realized some gains and rotated into healthcare and rotated more into financials and industrials. So there's typically going to be some level of rotation within the portfolios, as well as weighting or allocation changes.
So a couple of points that you had made that I wanted to dig down a little deeper if we can. So with the Federal Reserve, do you anticipate that they're going to continue to cut rates? And if you notice, these last several votes over the last year or so, generally the board votes unanimously and together, and that has not happened. I mean, even the most recent one was a 9-3 vote, and one of the governors voted against it because he wanted a 50 basis point cut. Right. So I guess my question mainly is, and this is of course for our the benefit of our audience, is for them to understand or what to expect. From your point of view, should we expect another cut in the new year, and how does that help the markets itself, and the equity markets itself? Will more money move into the equity markets as opposed to the fixed income area or bond markets?
Right. If I had to guess, which I guess I'm having to do right now, I think it is likely we will see at least one more interest rate cut early in the next year. A lot of that is predicated on what we're seeing in the employment numbers. Employment is weakening, and I think as a result, it gives the Fed, sort of room and the rationale to make an interest rate cut. But one of the things that's been interesting is, although short rates have been, coming down a little bit, the longer rates, especially the 10-year, actually have risen on each one of these interest rate cuts. So it's interesting because, the short rates will affect how much, for example, you're earning in your either your certificates of deposit or your short-term treasuries. But for example, from a mortgage standpoint, mortgages are more based upon what the 10-year is doing. So we haven't really seen mortgage rates come down, whereas the rate we're getting on our cash has diminished. But then there are other things, for example, credit card debt and other debt, which is pegged to shorter term borrowing, has come down. So different facets are affected differently by the interest rate curve. And so I think one of the biggest issues right now is the housing market has just been dead, and yet there's tremendous demand. So it will be interesting to see what, if anything, the government provides in the way of incentives or stimulus in order to help people, afford housing and get, provide more of an opportunity for housing, because that's one segment of the market that's really lagged. Lennar came in with their numbers yesterday, and they were disappointing. The stock has sold off, and in general, the builders have been weak. Companies like Home Depot aren't seeing the sort of the level of business they would anticipate. Now, if lower rates probably will help, especially lower short rates will help Home Depot, because people then can afford to borrow a little more for, if they're staying in their homes to make improvements, to fix things up. But it's going to be interesting to see beyond at least what I think is a initial interest rate cut. How much more will we see?
And you expect or anticipate that to occur sometime in the first quarter. Okay.
Yes.
Okay. And then you also mentioned the weakening job market. And, I have been concerned about that as well. But then the flip side to that, Jack, maybe you could, add to this. My comment from what I've seen is that between what has happened with the immigration policies, that over 1 million people that were illegal aliens that have left the job market, and you have now all these jobs that need to be filled or refilled because so many new companies are reinvesting in the United States, whether they're domestic or international companies or both. And then you also have the loss of 271,000 jobs, I think I read, of federal employees. So you have this massive decrease of jobs. And then you also have new jobs opening. And if we look at the statistics the way they are kept, if people drop out of the job market, which has happened over the last 3 to 4 years, they are no longer counted in the statistics. So when they come back in, the unemployment rate is going up a little bit, and the jobs numbers are really not increasing. I think the number that we got recently was 64,000 new jobs are created. So I don't know if what I'm describing, if there's any accuracy, but the reason why I bring this up is because we rely on these numbers as professionals and practitioners. And that has an impact on where you will ultimately invest for client accounts, correct?
Yeah, very much so. But it's also interesting, in terms of the job, that I think with a lot of the deportation, a lot of what I would call labor jobs, for example, in the housing industry, a lot of the people that are constructing those homes was probably, a good part of that immigrant population. In the area where I used to live in Bethesda, we had a number of rock quarries that, I know were were manned primarily by the immigrant population. What's an interesting, I guess, phenomenon right now are the young people coming out of college are having a much tougher time securing jobs, and that's where I guess they're competing with a lot of the other people that have been let go by government. So there are a lot of people, I think, with skills that should be and are very employable, but the job opportunities aren't necessarily there. And in some cases, I think there's going to have to be more retooling. I was listening today to a company that was merging with two educational companies, and they think their business is going to be very strong because a lot of people in the job market are going to need to revamp their skills somewhat in order to get jobs in especially in our ever-changing industries, especially with more of the adoption of different AI opportunities.
Yeah, I think you're absolutely right. I think our nation is in the midst of a major transition, if not even an overhaul of the labor markets. So to that point, aside, and you had pointed this out in the beginning of our discussion, is that there are certain sectors within the economy or within the equities market that are starting to pick up, other than the tech industry. You mentioned healthcare, you mentioned financials, and I would imagine even industrial, yeah.
Industrial, definitely.
So if they are picking up, I would assume that, job prospects in these particular sectors are also important.
Yeah, no, they very much are. But again, if you haven't been in the healthcare industry, how do you get that education or those skills? One of the things when I was growing up, people would go to work for companies like General Electric straight out of college, and they would be trained. Today, the hiring process is, we want to hire people that already know how to do the job. And so that's why, as I say, I think there's going to have to be some more retooling, re-education, for, the jobs are there, but do the people have the skill sets? And, that's,
that's part of that's part of the transition that we're going to go through.
Yeah.
I'm going to shift gears to what's your thoughts on consumer confidence? Because I have seen statistics and surveys that have been conducted, by the Consumer Confidence Board and the University of Michigan. They have their own each individual type of approach on that research. And it seems like there is a disconnect in our country and in our economy. There are people, when they're interviewed, say the economy is not doing well, they're not doing well, but spending patterns are not changing. No, people are going out to eat and they're traveling and they're spending money. They might be looking for deals, but nonetheless, they are in fact spending. And apparently, for the Christmas season, retail sales are up.
Yep. No, the money's still there, but it's skewed. Unfortunately, there's more of, I think, a group of haves and a group of have-nots. And, one of the big concerns is going to be what's going to happen with healthcare and insurance costs. And what's that going to mean for people? If you're, middle upper income, the stock market has been great. The house appreciation has been great. So, you have funds, you're confident. But if you're not if you don't own your home, and you're having to rental rates have gone up a lot. Inflation, food inflation. If you talk to people, that go out to restaurants, they are noticing costs are up. So it really depends where you are in the economy. The market, having had 3 great years in a row with probably 50 to 60% of the population owning equities, and that's been a big beneficiary for folks. or a big benefit. One of the interesting things is that also, younger people may not have built up enough money to purchase a home. So instead, they've been putting their money in the market, and as the markets have been going up, that's giving them more sort of disposable cash. So there is money there, but I think depending where you are, there's a lot to be concerned about.
Yeah, exactly. And you mentioned inflation, which is it has been a problem. It has come down, but I think also maybe you could add more light to this as well. Is I think that many of us don't realize that even when inflation goes up, it doesn't really come down. The rate of inflation might come down, but the fact that prices have gone up doesn't mean that they're coming back down. Is that correct, Jack? And how does that impact our investing?
Unfortunately, yes, but I think one of the ways that it impacts our investing is that's one of the reasons to own equities. They tend to be, beneficiaries of inflation. I bought my first house for $35,000. That same house today, I think.
Well, how many years ago was that? You're really dating yourself now.
Yeah, but that same house now probably sells for $700,000 or $800,000 anyways. So that's and inflation. We've seen periods of time when housing was flat or maybe down a little bit, but if you look at the trend, it continues to go up. If you look at the S&P 500, over a long period of time, it's always growing, and so that's why I think inflation is something that, as you say, it never really goes back down. It may flatten out, but that's, again, as I say, why one of the reasons why we own equities is because the value of those companies, they may stagnate for a little while, but ultimately businesses continue to grow. They're able to pass on costs. And
are businesses raising income to offset the inflation? Or are the individuals out there relying more on the equity side to help augment their income?
When you say raising income, you mean raising wages?
Yes. I'm sorry, wages. Yes. Thank you.
Yeah. No, you're seeing wages go up, but not that dramatically in general. Most of the people that I talk to are maybe seeing, annual 3% increases. So it's probably in line with inflation. So, yes, there is wage inflation as well, but, on a relatively modest basis.
All right. Before we go to our next question, I want to just let the audience know, be sure to like and subscribe to our podcast here. All right, Jack. One of the, it's interesting. Yesterday, I was listening to the local radio station, and I happened to hear, I'm sure you know the economist Stephen Moore, yes?
Mm-hmm.
Okay. Yes. He was being interviewed again on one of the local radio stations here, and I don't know who the gentleman was that the host, and then there was another woman who was that was interviewing, but he commented that he felt that the Dow Jones was going to reach 50,000 before the end of the year and 60,000 by the end of next year. What are your thoughts on that?
As a stockholder, I'd be very happy, but I think that's highly unlikely.
They were a little surprised by his bold statement, right. But taking that to the next point, where do you see the markets moving in 2026 based upon all the factors and variables that we just discussed over these last 40 minutes or so?
And I think we're in a position for, sustained growth right now. As I say, I think the reduction in regulations, the lower tax rate, if interest rates continue to come down, one of the things that's always been suggested is don't fight the Fed. If the Fed is easing, that's going to be positive. So I think there are a lot of reasons to be constructive on the market. Probably my biggest concern is that most people share that opinion. And so when everyone is optimistic, it makes me a little bit nervous. But I think in the near term, as long as earnings continue to grow, and there's every reason to think they will, I think the markets are poised for another good year.
Okay, so last year you were cautiously optimistic for 2025. So 2026, you're optimistic, but you're also concerned that everyone else is very optimistic as well.
Right, exactly. Yeah, I mean, as it ended up, being cautiously optimistic was too low, and so. But I'm always glad to be a little bit wrong if it's on the upside.
And it sounds of course, and it sounds to me that you are positive because of, I guess we could say the Trump administration is business friendly. And they're trying to find they're in trying to build almost every industry. You commented before about how the energy sector has to do better or will be doing better because of the AI buildout. And that reminded me of the fact that even nuclear industry is seeing a renaissance. And so to that point, are you investing in how are you investing in the energy sector itself, including nuclear?
Well, two of our favorite stocks have been Constellation Energy and Vistra, both of which have, multi-type utility sources, but both of whom are in the nuclear space, and will be very big in terms of the future of the data centers. So the hard thing is we started buying Vistra, back at, I guess, $25 or $30 a share, and it's sold off. Like today, it's down to 160 something, but we've seen it up over 200. And if you look at their balance sheet, and they've been buying back shares, they still have strong cash flow. So that's one of the companies we continue to like. The other, people are concerned about oil and gas, but I think natural gas in particular is going to continue to be a strong, element of the energy generation. So companies with a, sort of an orientation towards natural gas should continue to do well. So, we continue to like the energy sector, even with falling oil prices.
Yeah, and falling oil prices. I mean, I'm sure we're all witnessing it in some way, shape, or form, depending upon what state you're in. Even here in New Jersey, I filled the tank yesterday. It was $2.67 a gallon. Yeah. So, I think that helps people with their pocketbooks, and in in general across the board, because we don't realize it's not just the gas that you're putting in your tank. It's also the products that are being delivered to the stores. That means it's less costly to have those products delivered to stores for you to purchase, because the energy to take it to whether it's by rail or plane or truck is not costing as much. I have another question for you too before we wrap up. We discussed the Federal Reserve, and President Trump has really come down hard on Chairman Powell over the last many months, and he will be replaced, or his term is going to be up sometime in the spring. I think that's in May. But who do you anticipate that he might select to replace him? And I've heard that Treasury percent is a candidate. What are your thoughts on that?
Well, he says, Scott says he wants to stay where he is. Right now, I think the betting is on one of the two Kevins. So I'm not sure who's likely to come into favor and ultimately get the position. But I think probably the more, critical thing is that whoever becomes the Treasury Secretary has gone through Trump's betting in a sense. And the one thing that's clear is that Donald wants to see interest rates
Come down.
lower.
Right.
So I think with the new Treasury Secretary, we're going to again, that's another reason to think that interest rates will continue to come down. It's just, what is the degree and what are the impacts, on interest rates as a whole. That you can lower the short-term rates, but the Treasury market itself, is going to operate to its own, perspective. And that's why sometimes, even though short-term rates are going down, long-term rates could be going up. But I do think it's likely to be a Kevin. And I think we're likely to see short-term rates continue to be reduced.
Right. Okay. So in order for us to wrap up, I would like to see if you could just give us 3 main points that we should expect or look for in the new year in the equity markets.
Well, I mean, I think we're going to continue to have good earnings. So I think it's important to focus on which companies are likely to be the beneficiaries and are going to be able to continue to generate good numbers. I think it's also important to realize that while last year up until recently was driven by, sort of a number of technology companies in particular, the market is broadening. And I think there are going to continue to be, new opportunities in other segments of the market. And the final thing is, don't forget about the international markets. We haven't really talked about it today, but the international markets are selling at lower multiples, some of whom are going to be probably beneficiaries of a weaker dollar. Again, we haven't really mentioned much about it, but as interest rates come down, it's likely to result in the dollar, falling at least a little bit against some of the other currencies. And that tends to help companies, especially companies that are either have a lot of business abroad and they're repatriating dollars, or companies that are, foreign based that are able to be more competitive as the currencies fluctuate. So those would be, I guess, some of the points to keep in mind.
Yeah, very good points.
Diversity.
And when it comes, Jack said that from the beginning, diversification, and he's really emphasizing it again.
Yes, indeed.
Okay, very good. Jim, do you have anything to add?
No, it's always a pleasure having you on, Jack.
I appreciate the opportunity. Thank you.
All right, Jack, thank you very
Good luck
much.
in the new year.
Yes, you too. We will be talking very soon again. And remember, everyone, be sure to like and subscribe to our podcast.
And if you have any thoughts on where you would like us to go with topics, please let us know.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bellpoint Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. It does not constitute a solicitation to buy, sell, or hold a security or an investment strategy, engage in any financial transaction, and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only as of the date of the production or writing and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bell Point Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.